So it's great to be here in Prague on a lovely sunny day. It was the opposite of this when I left London yesterday. But my name is Ben Laidler. I'm the global investment strategist at eToro. We're the world's largest social investment platform with 30 million registered users in 100 markets around the world. And what we do is basically retail and DIY investors. Why should you care? These are probably the most important new actors in financial markets today. They're certainly the fastest growing, and they're almost certainly as well the most understood. And I'm just going to take 10 minutes of your time to try and correct a few of those misunderstandings. So this is a word cloud of the typical misunderstandings I think you'll find if you read the mainstream financial press or if you just go around and you're reading online. That retail investors are not investing, they're trading, they're taking too much risk, they're gambling in crypto, they're gambling in tech, they're gambling in meme stocks. Basically, they're buying high and they're selling low. Basically, they're the dumb money in markets. That's the perception, which I'm going to delve into a little bit. Why do these perceptions exist? I also think is important. We know an awful lot about institutional investors and what they do. There's a lot of surveys, there's a lot of analysis. You can't pick up a newspaper without people reading the tea leaves, what institutional investors are doing. There's nothing about retail investors, how they think, what they do. So we at eToro, we've tried to address this a little bit. I'll be referring to a lot of data in the next couple of slides that basically comes from a quarterly survey that's been run for us by an independent third party of 10,000 DIY investors around the world in 13 countries. So these three numbers, why you should care. On the left-hand side, 24%. That is the growth in the number of retail investors globally in the last 2 years per our survey. And it's very similar to the growth in the number of funded accounts we've seen on our platform as well. So that's a robust number. Think about that for a second. I challenge you to find another industry that is seeing those sorts of growth rates over the last couple of years, one. Two, we've had a bear market in the middle of this, and despite that, you're still seeing an industry growing the number of users by nearly a quarter. So, strong growth. Secondly, that bigger base of users is getting more active in markets. That's what the second number shows you. This is a number from the US Federal Reserve, which tracks what US households have been doing investment-wise over the last 20, 30 years. 38% is the percentage of all their financial assets that are in stocks today. That's a big number. It's an even bigger number when you put it in context. That's nearly an all-time high, and it's about half higher than the long-term average. So you've got more investors investing even more in stocks. And then the third number, they're doing it differently from a lot of other people. They're pretty bullish by nature, and I'll get into why in a minute. It's not irrational exuberance. It's because they have a very long-term view. But 78% of them are bullish on markets. They're positive on their investments. They tend to be reasonably contrarian. They have a longer-term view than any other investor in the market today. So these are the three reasons I think you should care. It's growing very quickly. They're very active in markets, and they're behaving differently from how other investors are behaving and how people think they behave. And this is a structural story. If you read the press, it's all cyclical. It's all, we got given stimulus checks in the lockdown. We had nothing else to do. We were just going to, play around on the internet. Absolutely, there was a little bit of that. But this is very structural. These are the 5 drivers here on the left-hand side. To confuse things, they're pretty recent. It really got going in about 2019, so just before the pandemic. But these, I think, are the 5 big drivers. One, the growth of online platforms such as ourselves, and there are others, making it easier for people to invest. Secondly, the community. The biggest disadvantage that retail investors have today versus institutional investors, they don't get any of the research reports that the investment banks put out. They don't get access to company managements. So how have they short-circuited that? They educate each other. So we've 30 million people on our platform. We're the biggest social investment platform in the world. You've all seen the growth of people like Wall Street Bets to 14 million people. This is retail investors educating each other and short-circuiting the disadvantages that they have in terms of access to information. Secondly, free trading, making it more accessible, making it cheaper. Fourthly, and probably the most understated and misunderstood, is the growth of fractional share ownership. This only started in 2019. The ability to own bits of shares rather than having to own the whole share. Just one statistic for you. So the average young investor under 35, the size of their investment portfolio today is only $10,000. If that's the size of your portfolio, and the priciest stock in the US is $5,000, or the priciest stock in Europe is $3,000, you're going to have a real problem putting together a diversified portfolio. So the ability to be able to own little bits of shares has really increased accessibility. And alongside this dramatic growth we've seen in ETFs, which is now a $10 trillion industry, that combination, I think, has made it a lot easier for retail investors to access markets in a diversified way. And then finally, there are demographic differences. You know, Gen Z, when you look at the data, they're very focused on taking more control of their lives, and that includes their financial lives. So they're getting out there, they're educating themselves, they're interacting on platforms such as ourselves, and they're building their portfolios. And what does this mean? These are the three things. It means growth. I've talked about that. This dramatic 25% growth in the last couple of years, you know, more than doubling over the last 5 years. But probably most importantly, it's pulling younger investors into the markets. The average retail investor is 31 years old. That's pretty much the average age on our platform as well. That's about a decade younger than the average investor in traditional finance. Why is that important? The eighth wonder of the investing world is compounding. It's time in the market, not timing the market. If you start investing a decade before everybody else or the decade before average, you're going to be richer, you're going to retire earlier, you're going to be building more wealth. And then finally, it's more female. So that 24% average growth over the last few years, 28% of that growth was female investors, 21% was male investors. Female investors underrepresented in markets. This is this rebalancing which is going on, driven by the accessibility. And I hate to break it to the largely male audience here, female women are better investors than men. The data shows you that over the long period of time. So let's get into some of the numbers from our survey. Just a few of the sort of misconceptions I want to sort of deal with. I mean, the first one is that they're just out there having fun, we're gambling, we're playing around in markets. Absolutely wrong. Here are the numbers. 10%, 12% see this as an alternative to going to the football or watching the movies. This varies a little bit by markets. I'm talking about you, Holland, where it's a lot higher than 12%, but the vast, vast, vast majority are in here for the long term. They want to retire early, they want to build security for their family, they want to build wealth for their family. A. B, what does this mean? The other big misconception is that everyone's out there day trading, we're trading, we're not investing. Totally wrong. Retail investors are thinking in years, not in days, not in weeks, not in months. The biggest advantage that retail investors have today over all other investors is the time horizon. The average age is 31. They're not going to retire for 30 years. They can look through the cycle, they can take the long view. Institutional investors will tell you they do the same thing, but their time horizon is 12, 24, 36 months. It's not 30 years. And we've seen this year. Retail investors have had a fantastic year. Why? Because they never sold their crypto, because they never sold their tech, because they took the long view, and these have been by far the best performing assets in the market this year. And then finally, they're not totally different, right? They share some similarities with everybody else. These are their favorite markets, their favorite sectors, their favorite assets. The favorite market is the US, probably not a big surprise. Their favorite sector, is tech. They tend to be younger. They tend to be digitally native. There's a natural affinity there, and because of the younger age, they are correct to be more risk tolerant and to have and to take more risk than older investors. But there are some pretty big differences. The other aspect of this higher level of risk tolerance and them being digitally native is a structurally high allocation to crypto. It's the biggest allocation that most young investors have. It's clearly done very well for them this year, did very badly for them last year, but they're not all working. Biggest theme, favorite by far, is clean tech, which has obviously been a miserable place to be this year. Just to finish off, I wanted to talk a little bit about the Czech market. It's one of the 13 markets we poll regularly in this survey, and there is some data where Czech investors really do stand out. The first one is just the sheer growth. The growth over the last couple of years is nudging 40%. So 40% of investors in the Czech Republic today are new in the last couple of years, and that basically means that the vast majority of Czech investors weren't investing 5 years ago. So very young market, very fast-growing market, and dramatically more than even the high growth rates we're seeing in the rest of the world. Secondly, the degree of risk tolerance, and this comes back to Czech investors being young, having a very long-term view, not retiring for, prepared to take more risk, being digitally native. They own a lot of crypto. Half of Czech investors own crypto, as dramatically more than the global average, which itself, I would argue, is very, very high. But then before you think they're being irrational, look at that final column. We asked investors, what do you look at when you analyze, what do you think drives markets? The vast majority, by the biggest one, it's the fundamentals, it's company earnings. This is one of the highest numbers globally. Elsewhere, it's a bit more balanced. Investor sentiment's very important, technicals are very important. Czech investors have been very fundamental. So these are just some of the differences. I'll end it there. Happy to take any questions, but I'll just leave it with you. Retail investors are the new kids on the block. They're very misunderstood, but they're not going anywhere. Thanks for your time.